Okay, so you've all sent us a really interesting collection of materials about accounts receivable factoring. And you know what? It seems like it's a particularly hot topic for those of you in the manufacturing world.
Definitely a lot of interest there.
So that's exactly what we're going to dive into today.
That sounds good.
We're going to try to sift through all of this information and really get to the heart of what factoring is and how it can benefit manufacturing businesses.
Perfect.
And, we don't want to bore you with a bunch of technical jargon and financial mumbo jumbo.
Right.
We want to keep this clear, concise, and insightful.
Yeah. Cut through the noise.
Yeah, exactly. Cut through the noise.
I think that's the key here. Manufacturing businesses are already dealing with so much complexity,
Absolutely.
trying to manage production, supply chains, and all of that. And then you throw in this financial layer of, managing cash flow.
Right.
When you have these extended production cycles, and then on top of that, you're waiting 30, 60, sometimes even 90 days to get paid by your customers.
Oh, yeah, for sure. It's like you're laying out all this cash up front for materials, labor, overhead, and everything else.
Exactly.
And then you're just kind of sitting there with your fingers crossed, hoping that the payments come in on time.
You got it.
And that's where this idea of accounts receivable factoring comes in.
Exactly.
It's like this potential solution to bridge that gap between, spending the money to make the products and actually getting paid for them.
Yeah, bridge that gap and keep those wheels turning.
Right, because the last thing you want is to have a successful business with great products,
Right.
but then be held back simply because you don't have the cash on hand to keep everything running smoothly.
Yeah, cash flow is king, right?
Mhm.
Especially in manufacturing where you have these longer lead times and those big upfront costs.
Absolutely. So to kick things off, let's break down exactly what accounts receivable factoring is at its core.
Sure. So in the simplest terms, accounts receivable factoring is basically when a manufacturing company sells its unpaid invoices, those accounts receivables, to a third-party financial company, which is called a factor in exchange for immediate cash.
Okay, so it's like instead of waiting for your customers to pay you, you're essentially getting paid upfront by this factor.
Exactly. And the factor then takes on the responsibility of collecting the money from your customers.
Got it. So they're kind of like taking over that whole collections process for you.
Exactly. They handle all of that, chasing down payments, sending reminders, all the administrative stuff.
So that frees up your time and resources to focus on what you do best, which is making great products.
Exactly. It allows those manufacturing teams to stay focused on production, quality control, all the things that really matter.
That makes a lot of sense.
Now, there is one important thing to clarify here.
Okay.
Factoring is not the same as accounts receivable financing, which is sometimes confused.
Oh, okay.
In financing, you're essentially using those invoices as collateral for a loan.
Right.
With factoring, you are actually selling those invoices outright to the factor.
Got it. So it's a sale of an asset, not a loan.
Exactly. Think of it like this. Financing is like getting a mortgage on your house.
Right.
You still own the house, but you owe money to the bank.
Right.
Factoring is like selling your house outright to get that cash immediately.
Okay, that's a really helpful analogy.
And I think that's crucial to understand because it has implications for things like your balance sheet and your overall financial health.
For sure. So let's say a manufacturing business is intrigued by this idea of factoring, and they want to know how it actually works in practice. Like, what are the steps involved?
Okay, so let's walk through that process.
Perfect.
The first step is pretty straightforward.
Yeah.
You, the manufacturing business, would gather up your unpaid invoices, the ones that are, from creditworthy customers.
Right, the ones you're pretty confident are going to get paid eventually.
Exactly. And you submit those invoices to the factoring company.
Okay.
Now, the factor isn't just going to blindly accept every invoice they receive.
Of course, they have to do their due diligence, right?
Exactly. They're going to do a bit of digging,
Yeah.
a bit of research to make sure that these invoices are legitimate and that your customers are actually good for the money.
So they're basically checking the creditworthiness of your customers.
Exactly.
Making sure they have a good track record of paying their bills.
You got it. And also look at things like the age of the invoices, the terms of the sale, making sure everything is in order.
So it's like a mini background check on the invoices themselves.
Pretty much.
Okay, so let's say the factor gives your invoices the green light. What happens next?
Well, here comes the good part. The factor will advance you a portion of the total invoice value.
Okay, so you get paid right away even though your customers haven't paid you yet.
Exactly. And this advance rate, it can vary depending on the factor and, the specific circumstances, but typically it's somewhere between 70% and 95% of the invoice amount.
Wow. So you could potentially get access to the majority of that cash almost immediately.
Exactly. And that's the real beauty of factoring for manufacturers.
Yeah.
It provides that immediate boost to your working capital, which can be so crucial.
Yeah, I can imagine that would be a game changer for a lot of businesses, especially those that might be facing a cash crunch or are looking to expand quickly.
Absolutely. And this upfront payment, it can often happen really fast, sometimes even within 24 hours of submitting the invoices.
That's incredibly fast.
Yeah, speed is definitely one of the big advantages of factoring, especially when you compare it to traditional bank loans, which can take weeks or even months to process.
For sure. So we've talked about the upfront payment, but what about the remaining portion of the invoice value?
So the factor holds back that remaining percentage as a reserve.
Okay, so they're not just giving you 100% of the money right away.
Right. They hold back a bit as a sort of safety net.
Makes sense.
Now, once the factor has advanced you that initial payment, they then take over the responsibility of collecting the full amount from your customers.
So you don't have to deal with any of the collections headaches.
Nope. They handle all of that, the phone calls, the emails, the whole 9 yards.
Sounds pretty appealing, I have to say.
It can be very beneficial, especially for busy manufacturing businesses that don't want to get bogged down in chasing down payments.
Right, it lets you focus on what you're good at.
Exactly.
Okay, so the factor collects the full payment from the customer, and then what?
Well, they take their cut, which is their fee for the factoring service,
Right.
and then they release that remaining reserve back to you.
So it's like you get paid in 2 installments, the upfront portion and then the reserve minus their fees.
Exactly.
Okay, now I know we mentioned this earlier, but it's worth emphasizing again that factoring isn't just one monolithic thing.
Right.
There are actually different types of factoring arrangements.
Exactly. It's not one size fits all.
So could you break down some of those different types for us?
Sure. So one of the main distinctions is between recourse factoring and non-recourse factoring.
Okay, and what's the difference?
So with recourse factoring, if for whatever reason your customer doesn't pay the invoice, you, the manufacturing company, are still on the hook.
Meaning you have to pay the factor back.
Exactly. You'd either have to buy back the invoice from the factor, or you might have to replace it with a different invoice.
Okay, so there's still some risk involved for the manufacturer, even with recourse factoring.
Right. And because the factor is taking on less risk in this scenario, their fees are typically a little bit lower, and you might get a slightly higher advance rate up front.
So it's like a trade-off, lower fees, but potentially more responsibility if things go south.
Exactly. Now, on the other hand, we have non-recourse factoring.
Okay, and how does that work?
With non-recourse factoring, the factor assumes most of the risk of non-payment.
So if the customer doesn't pay, the factor is out of luck.
Well, it's a bit more nuanced than that. It typically only covers non-payment due to the customer's financial inability to pay, like if they go bankrupt or something.
I see, so it protects you against customers going belly up.
Exactly.
But it doesn't cover things like disputes over the quality of your products or services.
Right. If the customer simply refuses to pay because they're unhappy with the product, well, that's a different story.
Got it. So it's important to understand the limitations of non-recourse factoring as well.
Definitely. And of course, because the factor is taking on more risk with non-recourse, their fees are usually higher.
Makes sense. Higher risk, higher reward.
Exactly.
Okay, what other types of factoring are out there?
Another key distinction is between notification factoring and non-notification factoring.
Okay, I'm intrigued.
So notification factoring is the most common type.
Okay.
In this scenario, your customers are notified that you have sold their invoices to a factor.
So they know to pay the factor directly.
Exactly. And this is typically pretty straightforward. The factor will send your customers a notice explaining the new payment arrangements.
Got it.
Now, on the other hand, we have non-notification factoring, which is a bit more discreet.
So the customer is kept in the dark.
Exactly. In this case, your customers are not informed that a factor is involved at all.
Interesting. And how does that work?
Well, you, the manufacturer, continue to collect the payments from your customers as usual. But behind the scenes, you have actually already sold those invoices to the factor.
So it's like a secret arrangement between you and the factor?
Pretty much. And this can be beneficial for businesses that want to maintain a certain level of confidentiality, or, maybe they're concerned about how their customers might perceive factoring.
Right. It kind of avoids any potential awkwardness.
Exactly.
Okay, so we've got recourse versus non-recourse, notification versus non-notification. Anything else we should know about?
Yeah, there's one more key distinction to keep in mind. Regular factoring versus spot factoring.
Okay, lay it on me.
So regular factoring, this is basically an ongoing agreement where you're consistently selling your invoices to the factor as they come in.
So it's like a steady stream of cash flow.
Exactly. It
Yeah.
can provide that reliable source of working capital, which can be really helpful for managing day-to-day operations.
Especially for manufacturers with, regular production cycles and a consistent flow of invoices.
Exactly. Now, spot factoring, on the other hand, this is more of a one-off arrangement. You might use this if you have a single large invoice that you need to get paid on quickly. Or maybe you have a few invoices that you want to sell for a specific short-term need.
So it's like a targeted solution for a specific cash flow gap.
Exactly. It provides that flexibility to address those occasional or, unexpected financial needs.
Got it. So you've got all these different flavors of factoring.
Exactly. And that's what's great about it. There's not a one-size-fits-all solution.
Right. You can really tailor it to fit your specific business needs and risk tolerance.
Exactly. And that's why it's so important to do your homework. Research different factoring companies, understand the different types of agreements, and choose the option that aligns best with your overall financial strategy.
Absolutely well said. Now let's talk about money.
Yeah.
Because obviously factoring isn't a free service.
Right.
So what kind of costs and fees can manufacturers typically expect?
Okay, so factoring companies, they make their money by charging fees for their services. And these fees are typically calculated as a percentage of the face value of the invoices you're factoring.
Okay, so it's not like a flat fee. It's a percentage based on the amount of money you're getting advanced.
Exactly. And the main fee you'll encounter is called the discount fee.
The discount fee.
And this is basically the cost of accessing that immediate financing that you get from the factor.
Got it. So it's like the price you pay for getting your money up front.
Exactly. Now, this discount rate, it's not set in stone. It can vary quite a bit depending on a number of factors.
Okay, like what?
Well, one of the biggest factors is the creditworthiness of your customers.
So if your customers have a history of paying their bills on time, you're likely to get a better discount rate.
Exactly, because the factor sees less risk in those invoices.
Makes sense.
On the other hand, if your customers are considered a bit more risky, well, the factor is going to charge a higher discount rate to compensate for that risk.
Got it. So it's all about balancing risk and reward.
Exactly. Now, another factor that can influence the discount rate is the age of the invoices.
Okay, how does that work?
Well, older invoices are generally seen as a bit more risky. There's a higher chance that they might not get paid.
So the factor might charge a higher fee for older invoices.
Exactly. They want to make sure they're covered in case something goes wrong.
Makes sense.
Now, in addition to those key factors, the discount rate can also be influenced by the overall volume of invoices you're factoring.
So if you're factoring a lot of invoices, you might get a better rate.
Exactly, because the factor is getting more business from you.
Makes sense. Volume discounts.
Exactly. And then there's also the specific industry your manufacturing business operates in.
Ah, okay.
Some industries are just considered riskier than others.
Mm-hmm.
Maybe there's a history of bad debts or longer payment cycles.
So that can play into the discount rate as well.
Exactly.
Okay, so there are a lot of moving parts that go into determining the discount rate.
Yeah, it's not a one-size-fits-all calculation.
So what's a typical range that manufacturers might expect to see for these discount rates?
It can really vary, but you might see rates anywhere from 1% to 5% of the invoice value.
Okay, so it's not an insignificant cost, but it's also not outrageous.
Exactly, and it's important to remember that you're getting a lot in return for that fee.
Yeah.
That, the immediate cash flow, the reduced administrative burden, the risk mitigation.
Right. It's all about weighing those costs and benefits.
Exactly.
Now, you mentioned earlier that there are sometimes other fees involved besides the discount fee.
Right. So in addition to that main discount fee, some factors might also charge service fees for various administrative tasks.
Okay, like what kind of tasks?
Well, it could include things like processing the invoices,
Right.
Verifying all the details, making sure everything is accurate.
Right.
They might charge a fee for conducting credit checks on your customers.
Yeah.
Really digging into their financial history.
Makes sense.
And they might also charge fees for managing the collections process itself.
Yeah.
Sending out payment reminders, making those phone calls, all of that.
So those are the kind of behind-the-scenes costs that manufacturers need to be aware of.
Exactly.
It's important to factor those into the overall cost-benefit analysis.
Absolutely. And just to reiterate what we discussed earlier, non-recourse factoring typically comes with higher overall fees compared to recourse factoring.
Right, because the factor is taking on more risk. they need to charge more to cover that potential loss.
Makes sense.
So when you're evaluating different factoring options, you really need to look at the big picture, the total cost of the service, and weigh that against the potential benefits.
Exactly. Don't just focus on the discount rate. Make sure you understand all the fees involved and make an informed decision based on your specific circumstances.
Couldn't have said it better myself.
Okay, so we've talked about what factoring is, how it works, the different types of agreements, and the costs involved.
Right.
Now let's really dig into why this is so relevant to manufacturers.
Sure.
What are the key benefits that make factoring so appealing for businesses in this sector?
Okay, well, one of the most significant and immediate benefits, and we've touched on this already, is the improvement in cash flow. Right. That seems like the biggest selling point for a lot of manufacturers.
Absolutely, especially when you consider the typical payment terms in many industries, which can stretch out for, 30, 60, even 90 days.
Yeah, it's like you're constantly playing catch up with your finances.
Exactly. And factoring, it just provides that much-needed injection of cash right when you need it.
So instead of waiting weeks or months to get paid by your customers, you can access a large chunk of that money almost immediately.
Exactly. And that can make all the difference, when you're trying to cover those essential operating expenses like purchasing raw materials, meeting payroll, paying your suppliers.
Right, all the things that keep the lights on and the production lines running.
Exactly. And having that cash on hand can also enable you to take advantage of opportunities that might otherwise be out of reach.
Like what?
For example, let's say you get a huge new order from a major customer.
Okay.
But to fulfill that order, you need to ramp up production purchase, more materials, hire more staff, all of that.
Right, which
Wow.
requires a significant upfront investment.
Exactly. And if you're waiting on those customer payments to come in, well, you might miss out on that opportunity.
You just don't have the cash flow to support it.
Right. But with factoring, you can access that cash right away and seize those growth opportunities.
That makes a lot of sense. And it's not just about taking on new orders. Factoring can also help you manage those seasonal fluctuations in demand that a lot of manufacturers face.
Exactly. Some manufacturers might have really busy periods followed by slower periods,
Yeah.
and that can make cash flow management a real challenge.
Definitely feasts and famines.
Exactly. But with factoring, you can smooth out those peaks and valleys.
Yeah.
Ensure that you have a consistent flow of cash coming in, regardless of the seasonality of your business.
Okay, so it provides a bit of stability and predictability.
Exactly. And then there's another interesting point that some of the sources mentioned.
Okay.
Having that readily available cash, it can actually enable manufacturers to take advantage of early payment discounts offered by their suppliers.
Okay, so it's like a chain reaction.
Exactly. If you have the cash on hand to pay your suppliers early, you can often get a discount on those purchases.
Which improves your profitability even further.
Exactly. So it's kind of a win-win situation. You're improving your own cash flow and you're potentially saving money on your input costs.
Makes a lot of sense. So improved cash flow, it's definitely a major benefit for manufacturers, and we've talked a lot about that.
Yeah, it's a big one.
But another key advantage that came up repeatedly in the materials we reviewed is the reduction of the administrative burden associated with collections.
Yeah, that's a huge one, especially for smaller manufacturing businesses.
Right, because chasing down payments, it can be a real time suck.
It can be, and it can also be a real drain on your resources. You might have staff who are spending hours on the phone, sending emails, following up on overdue invoices.
It's not exactly the most productive use of their time.
Exactly, and that's where factoring comes in.
Yeah.
It can essentially take that whole collections process off your plate.
So the factor handles all of that.
Exactly.
They have dedicated teams and systems in place to manage all aspects of collections, from verifying invoices to conducting credit checks to making those sometimes awkward collection calls.
So it's like outsourcing your accounts receivable department.
Pretty much. And that can free up your internal staff to focus on more strategic tasks.
Like what?
Well, instead of chasing down payments, your team can be focusing on things like improving customer relationships, analyzing sales data, identifying trends, looking for ways to improve your products or your processes.
Right. All those things that actually contribute to the growth and success of your business.
Exactly. And this can be particularly beneficial for small and medium-sized manufacturing businesses. They might not have the resources to have a dedicated collections team, or they might not have the sophisticated systems to automate a lot of that work.
Right. It's like leveling the playing field a bit.
Exactly. Factoring gives those smaller businesses access to the same level of expertise and resources as larger companies.
Makes a lot of sense. And I imagine that saving time and resources can also have a positive impact on your bottom line.
Absolutely. All those hours and resources that you're not spending on collections, You can reinvest those back into your core operations.
Right, into making better products, improving your efficiency, expanding your reach.
Exactly.
Okay, so improved cash flow, reduced administrative burden, both great benefits.
Yeah, definitely.
Now, there's another big one that I want to touch on, and that's accessing working capital without incurring additional debt.
Yeah, that's a huge advantage, especially in today's economic climate.
Right, because a lot of businesses are already carrying a lot of debt, and they're hesitant to take on more.
Exactly. And that's what makes factoring so appealing. It's not a loan, it's not a line of credit.
It's the sale of an asset, those unpaid invoices.
Exactly. And because of that, the money you receive from factoring, it doesn't show up as debt on your company's balance sheet.
Which is great for maintaining a healthy debt-to-equity ratio.
Exactly. And it also means that you're not adding to your interest expense, which can eat into your profits.
For sure. And this can be particularly important for businesses that might need to access other forms of financing in the future.
Right. If you're already carrying a lot of debt, it can be harder to secure additional loans or lines of credit down the road.
So factoring can help preserve your borrowing power.
Exactly. It keeps your options open.
Makes a lot of sense. Now, another aspect of factoring that's worth highlighting is that it typically doesn't require you to put up any of your own assets as collateral.
Right. Unlike a traditional bank loan, where you might have to pledge your equipment or your inventory or even your personal property.
Right. It's all about the creditworthiness of your customers, not your own assets.
Exactly. And that can be a real game changer for newer businesses or businesses that don't have a lot of tangible assets to offer as security.
Definitely makes it a more accessible option.
Exactly. And another key difference between factoring and traditional loans is that there are no fixed repayment schedules.
Ah, okay.
With a loan, you're typically making those regular monthly payments regardless of how your business is doing. But with factoring, the payments are directly tied to your sales cycle.
So you're only paying when your customers pay.
Exactly. It provides that flexibility, and it also aligns the cost of financing with the revenue you're generating.
Makes a lot of sense. So it's a more natural and organic way of financing your business.
Exactly.
Okay, so we've talked about the benefits of improved cash flow, reduced administrative burden, accessing working capital without debt. What else is there?
Well, another really important advantage of factoring is that it can actually help mitigate credit risks.
Okay, and that's a big concern for any business that's extending credit to its customers.
Absolutely.
Yep.
There's always that risk that some customers might not pay their invoices.
Right, and that can really hurt your bottom line.
It can, but factoring can help to minimize that risk.
How so?
Well, first of all, factoring companies, they're experts in credit assessment.
Okay.
They have the resources and the experience to thoroughly vet your customers before they agree to purchase their invoices.
So they're basically doing the due diligence for you.
Exactly. And that can give you a much better understanding of the financial health of your customers.
So you can make more informed decisions about who to extend credit to in the first place.
Exactly. It's like having an extra layer of protection.
Makes sense.
And then on top of that, with non-recourse factoring, remember we talked about that?
Right.
The factor actually assumes the risk of non-payment if it's due to the customer's financial insolvency.
So if a customer goes bankrupt, you're not left holding the bag.
Exactly. The factor absorbs that loss.
Okay, so it's like an insurance policy against bad debt.
Exactly. It provides that peace of mind that you're not going to be stuck with a bunch of unpaid invoices if one of your customers goes under.
That's a huge relief, especially for businesses operating in industries where there might be a higher risk of customer default.
Absolutely. And even beyond those specific risk mitigation features, factoring companies just have a lot of expertise in credit management and collections.
Okay.
They know how to effectively communicate with customers, how to negotiate payment terms, how to handle disputes, all of that.
So they're bringing that specialized knowledge and experience to the table.
Exactly. And that can really help to improve your overall payment collection efficiency.
Makes a lot of sense. Okay, so we've covered a lot of ground here.
We have.
Improved cash flow, reduced administrative burden, working capital without debt, credit risk mitigation, all great benefits.
Definitely.
But there's one final benefit that I want to touch on, and it's kind of a big picture benefit.
Right.
And that is the ability for manufacturers to truly focus on their core business activities.
Yes, that's so important.
You know, when you're bogged down with financial worries and administrative tasks, it's hard to really dedicate yourself to what you're passionate about.
Absolutely. And factoring it can really help to free up manufacturers to focus on what they do best, which is designing and producing high-quality products.
Exactly. It's like taking off that financial and administrative weight so you can really soar.
Exactly. And that can lead to all sorts of positive outcomes. More innovation, better products, happier customers.
And ultimately a more successful business.
Exactly.
So it's like factoring, it's not just about the numbers. It's about creating a more sustainable and enjoyable business environment.
Absolutely.
Okay, so we've talked a lot about the benefits of factoring for manufacturers,
We have.
but I think it's also important to compare it to some of the other financing options that are out there, so that manufacturers can really make an informed decision about what's right for them.
Absolutely.
So let's start by comparing factoring to the traditional go-to source of funding, bank loans.
Okay, good place to start.
So what are some of the key differences between factoring and bank loans?
Well, one of the biggest differences right off the bat is the collateral requirement.
Okay.
With a bank loan, you're typically required to pledge some form of collateral, whether it's your equipment, your inventory, your real estate, even sometimes personal guarantees.
Right. The bank wants to make sure they have something to seize if you default on the loan.
Exactly. But with factoring, the collateral is essentially the invoices themselves.
So it's the creditworthiness of your customers that matters most, not your own assets.
Exactly. And that can be a big advantage for certain businesses, especially those that might not have a lot of hard assets to put up as collateral.
Right, like startups or newer businesses or businesses that rely heavily on intangible assets like intellectual property.
Exactly. Now, another key difference is the approval process.
Okay.
Bank loans, they can be notoriously slow and cumbersome.
Yeah, you have to fill out tons of paperwork, provide detailed financial statements, jump through all these hoops.
Exactly. And the whole process can take weeks or even months.
And sometimes you get rejected even after all that.
Right.
But factoring is generally much faster and more streamlined.
Exactly. You submit your invoices, the factor does their due diligence, and you can often get approved and funded within a matter of days.
Wow, that's a big difference.
Yeah, speed is definitely one of the big advantages of factoring, especially when you need that cash infusion quickly.
Absolutely. And speaking of speed banks, they also tend to have much stricter eligibility criteria.
Right. They're going to look closely at your credit history, your business plan, your financial projections, all of that.
So you need to have a pretty solid track record and a convincing story to get a bank loan.
Exactly. And if your credit score isn't great or you haven't been in business very long, well, it can be really tough to qualify for a bank loan.
Right. But with factoring, the focus is more on the creditworthiness of your customers.
Exactly. If you have a strong base of reputable customers who pay their bills on time well, you're much more likely to get approved for factoring, even if your own credit history is a bit shaky.
So it's like a back door to financing.
In a way, yeah, it opens up opportunities for businesses that might not be able to access traditional bank financing.
I like that. Now, another key difference is the impact on your credit rating.
Right. So taking out a bank loan, it's going to show up as debt on your balance sheet.
And that can potentially lower your credit score.
Exactly. And it can also make it harder to secure additional financing in the future because, lenders are going to see that you already have a certain level of debt.
But with factoring, it doesn't directly impact your credit rating.
Right, because it's not a loan. It's a sale of assets.
So it's like an off-balance sheet form of financing.
Exactly. And that can be really attractive for businesses that are trying to keep their debt levels low.
Definitely. Now let's talk about cost.
Sure.
Obviously, both bank loans and factoring, they have costs associated with them.
Right.
So how do those costs typically compare?
Well, with a bank loan, you're going to be paying interest on the amount you borrow.
Right. And those interest rates, they can vary depending on the lender, the type of loan, your creditworthiness, all of that.
Exactly. And you're usually making those regular monthly payments over a set period of time.
Right.
With factoring, the cost comes in the form of those fees that we talked about earlier.
Yeah.
The discount fee, the service fees.
Right. And those fees are typically calculated as a percentage of the invoice value.
Exactly. And because of that, the cost of factoring it can fluctuate depending on the volume of invoices you're factoring, the creditworthiness of your customers.
Yeah.
Those factors that we discussed earlier.
So it's not always an apples-to-apples comparison.
Right. It really depends on the specific circumstances.
Now, one final difference I want to highlight is the focus of the assessment.
Okay.
When you're applying for a bank loan, the bank is primarily focused on your business.
Right. They want to see your financial statements, your business plan, your track record, all of that.
But with factoring, the focus is primarily on your customers.
Exactly. The factor is most interested in the creditworthiness of the entities that owe you money.
So it's like two different lenses, two different perspectives.
Exactly. And that's why factoring can be such a good option for businesses that have strong customers but might not have the strongest financial track record themselves.
Absolutely. Well said. Okay, so we've compared factoring to bank loans.
Yeah.
Now let's talk about another common financing tool that manufacturers often use, and that's a line of credit. So how does factoring stack up against a line of credit?
Well, similar to the comparison with bank loans, factoring, and lines of credit, they operate on fundamentally different principles.
Okay.
A line of credit is essentially a pre-approved pool of money that you can borrow from as needed.
Right. You draw down on it as you need cash, and then
Yeah.
you repay it over time.
Exactly, and you typically pay interest on the outstanding balance.
Right, but with factoring, you're not borrowing money at all. You're selling an asset, those invoices.
Exactly.
Okay, so that's a fundamental difference.
It is, and it has implications for a number of things, like how the financing is reported on your balance sheet and your overall cost of capital.
Makes sense. So what are some other key distinctions?
Well, one thing to consider is the advance rate.
Okay.
With factoring, you're typically getting a higher advance rate on your invoices, meaning you're getting a larger percentage of the invoice value up front.
So you're getting more cash in hand more quickly.
Exactly, and that can be a big advantage for businesses that need that immediate boost to their working capital.
For sure.
Now, with a line of credit,